Hi everyone, I'm Shawn Pemberton, and I'm excited to guide you on your financial journey. Whether you're looking to save, invest, or plan for the future, you're in the right place. Get ready for expert advice on budgeting, investment strategies, debt management, and real-life success stories that will inspire you to take control of your finances. Join me as we break down complex financial topics into easy-to-understand lessons, empowering you to navigate your financial future with confidence. Welcome to Navigating Your Finances, your trusted resource for mastering your money and achieving financial freedom. Hello, everyone, and welcome to Navigate Your Finances. This is our time to just come together and give you financial information that will help you on navigating your financial journey. Today, we're going to be talking about insurance basics. As we look into our different areas of finances, we're going to look at insurance today and some insurance basics. We're going to start with talking about why even purchase insurance. Well, we purchase insurance to minimize the negative impacts of life events like car accidents, natural disasters that may destroy our homes or do damage to our homes, illness, or even death. My former pastor used to say, there's a grave in your pathway and you can't go around it. So insurance is necessary to help us in being defensive against these kinds of things that happen. Life happens. What do they say now? Life be lifing. So we need to protect ourselves in certain situations. Today I'm going to cover required insurances, also look at insurances you may need, and then lastly, insurances to avoid. Come on along with me on this journey. Our first topic is just required insurances. And I did some research on this just to make sure that I understood all of the required insurances that we had. And it was interesting what I found. First of all, with car insurance, all states but New Hampshire require car liability insurance. And that's to cover bodily injury and property damage of the person you may have hit. Collision insurance is for your own car, but states require that you have car liability insurance, most states. Then there are mortgage lenders. They require that you have homeowners insurance. If you don't believe me, stop your insurance policy, and you will hear from your mortgage company saying, I'll no longer insure you unless you get homeowners. I'll no longer lend to you unless you get homeowners insurance again. So we have car liability as a required insurance, and then homeowners insurance as a required insurance. And then the last one's a little tricky. The federal government mandates health insurance, but there are states that have repealed the federal government requirements, but yet and still they have their own individual mandates and penalties. So to just put it straightforward, health insurance is a required insurance rather than try to navigate all the ins and outs. So what do we have as required insurance? Car liability insurance, homeowners insurance, and health insurance. Then as we move on, what about those insurances you may need? This depends on everyone's individual situation. And in fact, everything that we talk about here in our financial navigation depends on your individual situation. This is information for you to use as a springboard for your own personal situation so that you could be fortified against the things that may occur in life. So first of all, I'm going to talk about disability insurance. Your greatest asset is your ability to work. So with any other great asset, you want that ability to be protected. Just in case you have something to occur such that you're not able to work. Disability insurance is particularly important for those that are the sole income earners. Myself, I'm single. It's important that I have disability insurance, especially when I was working. Because if something should happen to me, no one is taking over my personal responsibilities. So if you are a sole income earner, even if you have a family, if you're the only person earning income, you should have disability insurance, just in case you're not able to work. Oh yeah, I know about workman's comp. I've heard that before. And not that it's bad, but not everybody has access to workman's compensation. I worked as a government contractor, so that was a different implication for me. Then I want to also explain disability insurance. Most companies offer a long-term disability insurance policy, and that you pay a few dollars per pay period. One thing to keep in mind, though, if you change companies, that insurance is no longer in place for you. This is true also of life insurance. When we get life insurance, any kind of insurance through our company, if we change companies, that insurance is no longer in place for us. So it's important to understand that. So what I would recommend is that you do an independent disability or individual disability insurance policy. In that way, no matter if you change jobs or stay on a job, you will continue to have that policy in force in the event that something happens. Now, when I talk about individual disability insurance, there are a couple of things to keep in mind. One is that there are different types. Some examples are 5-year disability, and then there are also the opportunity to have a disability policy intact until you're age 65. This is something that you should talk to an insurance broker about to look at what your options are. The second thing to keep in mind with disability insurance is the deductible. I know you've heard that word before, and it takes on different forms depending on what kind of insurance you're talking about. With disability insurance, your deductible is a time period. In other words, you submit a claim for your disability insurance. The claim gets honored. The deductible is the time period before you actually start getting payments. If you have a 30-day deductible, then that means you need 30 days or months of expenses to be able to pay before the insurance company starts to pay the claim. The other type of deductible period, is a 90-day period. And with that, you have a longer period of time that you need to be able to pay. But the good thing, the advantage of a longer deductible or a longer period of time is that you pay less of a premium. So then, and my rule of thumb is that you want to make your deductibles, and this is with any insurance, as high as you can so that you're paying a lower premium. Remember, insurance is for just in case something happens. So you look at just in case and you say, just in case I become too ill to work my current job, then I want to have a deductible that matches with what I have saved up. And you want to try to do your deductible as high as possible so that you're not paying high premiums every month. I hope that makes sense for you. The other thing to keep in mind is the fine print, and that is with any insurance policy. Back in the day when I did independent consultations with people, I found that most people did not know the ins and outs of their insurances. And they would be surprised when they submitted a claim and there would be some gotcha in the fine print that would cause them to not be able to have the claim honored. So with disability insurance, one fine print aspect is that of any work versus the type of work you do. Now, oftentimes the company policies, they won't pay your claim if you could do any work, which means, say for instance, you were working as an architect and something happens such that you're not able to work as an architect and your earning power is affected. Well, some policies would say, if you can flip fries at McDonald's, we are not going to pay that claim because you could do any work, even though it may not be the work that you did before that earned you the money that you did before. Then there are policies that would say, if you can't do your work, the work that you have been trained to do, then we will pay the claim. So read the fine print before you sign that contract so that you can know whether they will pay a claim only if it's your work or they won't pay a claim if you could do any work. That's an important aspect of disability insurance. One other thing I'll mention about disability insurance is that they do not pay your your 100% of your salary. They'll pay a percentage, perhaps 60%. So once again, you're going to have reserve to make up for what your expenses are, or you're going to have to significantly reduce your expenses while you are disabled. So those are just a few things to keep in mind when it comes to disability insurance, which is an insurance that you may need, especially if you're the sole income earner. Now I'm going to move on to life insurance. Now, life insurance is, again, one of those individual things. We should buy life insurance or be insured with life insurance if we have dependents. Single person, no children, probably don't need life insurance. But what you would need is some account so that someone can bury you. And in that case, you could do a transfer on death, checking or savings account so that the person that's the beneficiary can take that money and provide for your burial. So we don't always need, as single people, we don't necessarily need life insurance. Now, if we have children, you have dependents, so you want to consider getting life insurance in that case. With life insurance, you want to buy enough life insurance to cover everything that you want to have covered. If you're a young couple with children, I recommend that you sit down together and decide, in the event of someone passing, what needs to be covered. Does the children's education, does the mortgage needs to be covered? Whatever it is, decide what it is that you want to cover, and then use a resource to calculate how much life insurance you need to cover it all. Before you even start talking about buying life insurance, understand how much you need. Then as you get that understanding, then you can perhaps look at types of life insurance. There are two basic types, term insurance and permanent insurance. Term insurance is exactly what it says. It lasts for a period of time, maybe 20 years, maybe 30 years. But after that period of time, if you've lived that long, term insurance is going to go up. Because the insurance company, at that point, you're older and you're a higher risk for them. So that risk is going to be transferred to you in the amount, the cost of your premiums. So also term insurance is often designed for you in your earlier years, whether you're single or a single parent or married. The idea is that early in your years, you don't necessarily have a lot saved. So then you want to cover yourself in the event of death with a lot of insurance. So term enables you to buy a high death benefit at a low cost. Then once you've accumulated money, that's why the term, they're figuring over 20 or 30 years, you've accumulated money, you've done some investing, you've done some saving, so you don't necessarily need as much insurance. But if you do, you're going to pay the cost for it. So then term is really for your growing years, and that's why it's term. It's cheap insurance, you get a lot of coverage, and it's for your growing years. Now let's look at permanent insurance. Exactly what it means. It says it's permanent. It's intended to last you your entire life. There are three types. There's whole life insurance, there's universal life insurance, and there's variable universal life. The different types are based upon, you build up cash value with permanent insurance. And the types dictate how that cash value gets invested. With whole life insurance, the cash value gets invested in things like CDs or savings accounts, so it doesn't really earn very much. In universal life, you might get investment in bonds, those types of things, so you get a little more return. And then there's variable universal life, in which the cash value is invested in the stock market. So you have a lot of opportunity for good return, but you also incur risk. No risk, no reward. That's just the truth of life. So you have term insurance, and then you have permanent insurance. And again, you determine what total amount of insurance that you need as a family or as a organization. However, you decide how much insurance you need. Then there's a hybrid plan, which says get your term insurance, a high amount, but also get permanent insurance early on in your life, a smaller amount, so that you'll be paying a lower premium and that insurance cash value is growing. And then when you get in your later years, you keep that premium managed with your cash value, but in your later years, you're not going and buying insurance for the first time. All of this insurance should be purchased when you're younger, so that you can get a lower cost of insurance. So that's the idea with life insurance. We're going to move on now to talking about insurances to avoid. First is mortgage insurance. I mean, the type of insurance where it says, if you die, someone will pay. The company will pay your mortgage. As I mentioned earlier, get enough life insurance to cover your mortgage if you've decided that's what needs to be done. Then there's accidental death and dismemberment insurance. And I know you're going to say, that's a small premium. Yes, it is. Keep your money, because even though it's a small premium, if you ever lay claim to it, very seldom will it pay out. That's why it's so inexpensive. Again, cover everything with life insurance. Stay away from the specialty insurances. Another one is life insurance for children. Remember I said you purchase life insurance if you have dependents. Well, children do not have dependents, nor are they typically income earners. So just like a single person would set aside an account for burial, consider setting aside monies for burial of children. That's a very difficult thing, and God forbid it should happen. But if it does, refrain from using life insurance or buying life insurance policies for children. Then the last one to avoid is credit insurance. I didn't even know this existed, but apparently it does. You could buy insurance to pay off credit. Well, why not just use that premium to pay down the credit? That's another way of addressing the idea of credit insurance. That's my information with regard to insurance. I hope it was helpful to you. And tune in next time when we'll look at savings. Bye for now. Don't miss out on valuable insights. Subscribe to our channel, hit the notification bell, and become part of our community dedicated to financial success. Let's embark on this financial journey together. See you in the next episode.